Zachary Myers from Heidelberg University. I'm the captain of the Heidelberg University CFA team. Getting into the nitty-gritty of the company and really figuring out how they make money, not just focusing on the valuation models, but actually figuring out, in the case with Kellogg's, how they connect with their customers and get them to buy that product as well as pay that price premium. So. Probably getting the spreadsheet to work off the bat and really getting the initial number crunching down, because that kind of gives you your first look into how the company is doing just on the balance sheet. And the excess research, it takes time, but it's not that hard. And I find that a lot more interesting as well as my teammates did. So really that initial valuation. Definitely. I think it's really great for students to be undertaking this, because not only for the professional work, but other classes and graduate work, and at that level, because it really helps you to figure out what you need to do in order to value a company accurately and actually put in a lot of work, because this is a lot more than just your typical undergraduate business class or even entry-level MBA. So. I think it's giving me a lot more confidence in going out and looking for work in either the finance industry, business industry, or anywhere I choose to work, just because we undertook a project and we completed it satisfactorily and on time as a unit. So I think that's a really good lesson for any students to take forward.
Good morning, everyone. Welcome to Heidelberg University's presentation on Kellogg Company. My name is Lauren Ash.
I'm Erica Huffman.
I'm Dorian Kemp.
And I'm Zachary Myers.
Our current recommendation for Kellogg is a hold, with a current price of $62.21, an intrinsic value of $58.55, and a 12-month target price of $61.34. Kellogg is a member of the processed and packaged food industry. This industry is highly competitive and highly concentrated. Kellogg's main competitors include General Mills and Kraft. Producers in this industry acquire raw materials and then process them into cereals, bars, and other products. One of Kellogg's most well-known products is cereal. Although the breakfast market has seen an increase in consumption within recent years, the cereal market has actually seen a 3% decline within the past year. This is due to the availability of more convenient breakfast options, such as drive-through breakfasts. However, Kellogg's is working to combat this through introducing new products, such as its beverage Kellogg's To Go. Important consumer trends in this industry include the changing taste buds of consumers limiting their loyalty to fewer brands, and also the growing popularity of private label brands. However, quality still proves to be an important factor while shopping. Kellogg produces breakfast cereals, savory snacks, and frozen processed foods. Kellogg is the world leader in the breakfast cereal market and is the world's second largest producer of savory snacks. Acquisitions and joint ventures have contributed to growth of the company throughout the years. Currently, joint ventures exist in Turkey and China. Kellogg's most recent acquisition was Pringles, and this acquisition has great growth potential for the company. Kellogg's is unique in that it has a focus on innovation and branding relationships. For example, the brand Frosted Flakes has been around for over 50 years and is marketed based on the idea of sharing what you love with who you love. Brand relationships and brand longevity create value for the company of Kellogg's. Kellogg's divides its sales into 7 different reportable segments. In 2012, the combination of U.S. Morning Foods and Kashi and U.S. Snacks made up almost half of Kellogg's total sales.
Kellogg differentiates their products through brand recognition and health, and they use that superior brand recognition as a competitive edge over their rivals. Another aspect of their business model is their global operations. They currently manufacture worldwide and market in over 180 countries. By doing so, they are able to locate their manufacturing facilities near their distribution centers to cut distribution costs. When you look at their brand portfolio, you may recognize many of their brands. This is because they lead the industry in advertising, which allows them to command a price premium of 20 to 40%. Kellogg plans to grow in 4 ways. The first area for potential growth is through the cereal industry. They currently lead the industry with 40% market share. However, there is still room to expand on that even further. Another area in which they plan to grow is in their global snack business. With their newly acquired Pringles, they now have a global platform to do so. Another area in which there's potential for growth is their frozen foods. Their two main brands, Morningstar and Eggo, in the frozen food segment both have room to grow as well. And lastly, they plan to grow through emerging markets. They currently exist in India, Brazil, and South Africa. However, opportunities still exist throughout the world.
This is our Porter's 5 Forces analysis for Kellogg, and investors should be concerned about two main forces. First, rivalry, which we gave a rating of strong, because the industry is highly competitive and concentrated. With 3 companies owning majority of the market share, Kellogg has to continue to develop new products in order to retain their current market share. The second is the threat of substitutes, which we also gave a rating of strong, with price-sensitive consumers often going to that lower-cost product rather than purchasing Kellogg's premium-priced product. Kellogg's future sales are threatened, as well as their future profits. Our investment thesis is based off of revenue drivers, margin drivers, and risk factors. Kellogg has the potential for future growth. However, revenue and margin drivers, as well as risk factors, often threaten this growth. Our recommendation for Kellogg, again, is a hold, and that's based on the factors that we inputted into our 4 valuation models. The models being the discount dividend model, free cash flow model, residual operating income, residual earnings, and then we took an average of the 4 to come up with our intrinsic value of $58.55. Revenue drivers for Kellogg include the emerging markets, the state of the economy, advertising, and acquisitions. Emerging markets provide Kellogg with potential growth with joint ventures in China and Turkey. However, a major concern with these emerging markets is that the cultures in these countries will not accept Kellogg's products. The state of the economy is also a revenue driver. If the economy is doing well, those price-sensitive consumers are more likely to purchase Kellogg's premium-priced products. Advertising is important to Kellogg because it gets their brand name out there, which is a big part of their business strategy, and it also keeps private labels at bay. Finally, acquisitions. Kellogg acquired Keebler in 2001 and Pringles in 2012, and it has increased their revenue significantly.
All right, so with margin drivers, when you're looking at a food company, obviously the cost of the raw materials that make that food is going to be a big factor in how you make your money and your gross margin. So as you can see, they have to deal with a seasonal basis, how much food's going to cost, how much your rice, your other grains are going to cost. Energy cost is also very important for the transportation of these products as well as in the manufacturing of these products. Kellogg's has a fleet of 800 diesel-powered trucks, obviously. That's going to be a factor in there, as well as propane, oil, and other gases that are used in the manufacturing of their products. Project K is a big factor in the margin drivers. It's going to be going over the next couple of years looking at saving millions of dollars, and it's really working on building a global supply chain. So becoming more efficient in their capacity and in the distribution of their products globally. A big part of that is working to align their products behind regional hubs so they can put the best product for the best region and ensure that those products are being used efficiently in each and every market. When we look at risk factors, cost of commodities has already been covered, one by kind of the margin drivers and all that. Obviously, they use some futures to hedge that risk, but that can change, and you can only hedge for so much. Obviously, if there's an absolutely horrible season of crops, that's going to hurt. Fuel cost is also important, once again, because that can fluctuate a lot, especially with the current trend in fuel prices constantly rising, especially in gasoline and oil. So that's a big issue. Adulterated products has not been covered yet, and that's speaking to the issues such as Kellogg's having the shredded mini wheats incident where they had metal flakes found within their cereal. Now that's costly not only at the material level as far as litigation and recalling the product, that's also costly as a brand. And when you're a company like Kellogg's that makes a living based off its brand recognition and making relationships with customers, you're really going to get hurt when they can't trust the product you're giving them. Obviously, they're in a highly competitive industry, as already been mentioned. That's always a risk factor. If they're going to lose market share in any one of those areas, it can really hurt growth, revenues, and profits. Economic recession is also another issue, as mentioned before, with the private label and the threat of substitutes in the cereal market. Now, as any international company is going to have issues with currency, especially with the fluctuations and how you're valuing assets across countries, and as well as kind of valuing those cash flows from various countries. So that's another risk factor that they must deal with. Finally, emerging markets have been touched on several times in this presentation, but it's important to note, such as countries in China and Brazil that have massive cultural differences from the countries that Kellogg's has gone after before, such as China, which prefers more of a hot and savory breakfast, not a cold cereal, and Brazil, which lacks a word in their language for breakfast. So that's a little bit of a shortfall to deal with. Now you'll see here we have a sensitivity analysis, and I want to point out two things you primarily are the sales growth and gross margin. Now, as you can see with sales growth, it can affect the stock price relatively well or bad, depending on which way it's going. And that's mainly because it has been a significant growth in sales over the last several years with Kellogg due to their acquisition of Pringles. So it doesn't look like it necessarily hurts them too badly. However, sales growth is always going to help any company. And gross margin I want to point to a lot more simply because of the fact that a lot of what Kellogg's is doing now with their demand sensing and with Project K is working on reducing that margin and bringing in and keeping more of the money that they're generating from their revenues. So obviously, any type of shift in that is really going to affect their bottom line. And that's why it's a wise decision to hold, because of the fact that Kellogg has a great growth potential because of their actions to try to reduce their marginal cost and as well as to account for the risk factors and the fact that they're getting into emerging markets. However, it is hard to see whether or not that will pan out in the next couple of years. However, because of Kellogg's safety in the industry and being a relatively stable industry, it is better to let them sit and see what happens with the stock price. Thank you.
Can you talk about how you came up with your price targets?
The price target, 12-month price target. We'll talk about that for a while.
The 12-month, or are you talking about our evaluations?
I mean, your evaluations, you did a bunch of different things, but you didn't really talk about
The discount dividend, you did it by free cash flow, the intrinsic value.
We did that. We did all 4 of those models because we thought we wanted to get a really good picture of the company. So obviously, Kellogg does pay out dividends. They always have had relatively sizable free cash flows. They also reinvest a lot of their money back into advertising as well as research and development. So we wanted to get all 4 of those models, look at all different aspects of the company, really get a good picture, and then that's why we decided to average all of those. We didn't just want to go with a simple dividend discount or a simple free cash flow and then say, well, it's okay. So by averaging all 4 of those, we thought we got a better picture of the company as a whole.
You mentioned that advertising, they spend a lot on advertising, and it allows them to be to have to price their products at a premium. Is there any evidence that that can demonstrate that benefit of advertising?
As a benefit, I'm not sure, but we do have, on the slide, it showed that they do spend a lot more in that advertising. And I think that just shows with their market share, with them having about 40%, I think it shows that spending in advertising.
Yeah, I
It
think
has done
you
well
can,
for them.
it's one of those things where you can kind of look at the way they're doing right now and the way they've done in the past that kind of explains how their advertising works. I mean, every person in this room has probably seen Tony the Tiger. You might not automatically associate that with Kellogg's, you might not know that name, but you know Frosted Flakes. And if you're looking for cereal, you're going to look for a lot of those Kellogg's brands without realizing what company
I
it
guess
is.
my question is this: really, are they forced to advertise, spend a lot of money on advertising just to defend their market share? I mean,
I would say that's a correct statement. They are forced to spend a lot on advertising, but I'm not necessarily sure if it's going to hurt them in the long run, because it seems like even General Mills spends a fair amount on advertising. Do they spend as much as Kellogg's? No. But I think that is a valid concern, the fact that they are probably going to have to continue to spend a lot of money on advertising for the foreseeable future.
They have made 2 major acquisitions they're working through, and it appears that they're growing by acquisition. Are there any other businesses that they're looking to expand on, or geographic locations that they're looking to expand by acquisition?
I can take this one. Not necessarily through acquisition right now, but with Project K, they are working on their supply chain, which is going to help them cut costs and then reinvest in their company. They announced the project, I believe, in November, and then in January, they actually announced they'd be closing a plant in Australia and Canada just because of how they were producing. They're going to expand a plant in Thailand and also open a new plant in Malaysia, which will become a regional snack hub, they call it, for Pringles, and really help get Pringles into the Asia Pacific market. So we'll see a lot more growth from Pringles through that.
And also they've also done a lot of joint ventures, as mentioned in the presentation, so I think that's probably going to be the path they take in the future. They're still looking to grow, however, they're not going to go out and make another multi-billion-dollar acquisition of a large company. Pringles was kind of a golden opportunity for them, especially since it was already located with a group that really couldn't use it effectively. They kind of were able to just cut it out of that company and bring it over, and they could really have a synergistic effect with the products they already carry by adding Pringles, and also get a little bit more global.
In your evaluation estimates, what kind of an assumption did you use for their organic growth and acquisition growth going forward when you were doing the dividend discount model?
You said the organic growth?
Right.
We looked at acquisitions because with acquisitions, I think they had a 4% or 14% growth this last year, and that was a little abnormal with the acquisition of Pringles. So we really did cut it down. We took an average of really their constant growth lately, and then with their acquisition to come up, I think we had a 7% growth.
And the breakdown in that 7% between organic and acquisition would be like 3% organic growth going forward?
I would say that'd be about correct. About 3% would be normal, and 4% with the acquisition, because that's still kind of coming through. It won't be coming through as strongly as it was, but.
And you have it as a whole, and again, a lot of people may recognize if it's in their portfolio, they're buying Kellogg because of a dividend stock for income. Do you see them maintaining their dividend policy going forward, given that they have to reduce debt and maybe make an acquisition, but will they maintain the current payout ratio over time?
I believe they will, because if you look at the dividends they've been paying out, even when they acquired Keebler, they were still paying dividends. So it's almost, you have another case study to look at with how they acted after Keebler, and they kind of kept the ship on course and never really altered too much. So I wouldn't be surprised if they maintain, and I expect they'll maintain their dividends, because they've shown they can handle that debt in the past.
Yep. And then you have it as a whole, but at some point, do you like the company enough where it will be a buy at a certain price?
Definitely, and it does matter what the price is, but at the same time, as you see, and I don't know if you looked at Kellogg's recently, this original stock price was from a little while ago, but they're getting pretty close to what our intrinsic valuation was.
Yeah.
So I wouldn't necessarily say it's I'm not sure what point I would go at the buy, but I'm looking to see what that sales growth is,
Yep.
and try to catch it a little bit before the price even jumps at all. Because it's really depending on what they do in China and what happens in South America. So that's, plus you're not going to see huge jumps in that price because it's a relatively stable industry. So I'm not sure if you're going to make that much money from
Correct.
playing it too tight.
And you mentioned with some of the risks they were doing hedging. Do you know if they're hedging a lot on their commodities in a foreign exchange, or?
I'm not sure how to say how much. I mean, I know they have enough to cover, to ensure that they aren't going to have a disaster in any year. So that means they probably have a very large scale of futures and options. I can't say to what exact extent though.
And as it relates to the second part to that is just in currency. One of the risks that you had is that currency sensitivity. Do they hedge on currency?
Yes, they also hedge in there. They hedge in all areas of the risk factors. As far as the fuel, they hedge a bit. The food, they try to hedge as much as is cost effective, and they hedge also with the currency risk.
And you had the opportunity to meet with the company and management. What's your sense on the quality of management at Kellogg?
I would say they're very passionate about what they're doing. One person that presented to us mentioned how he left the company and then he thought he was done, and then he came back and he's so much happier that he's back. So I would say very passionate about what they do.
I'm interested in your opinions regarding Project K. How believable is it? Do you think they're going to be able to achieve the targets that they've set? Because I notice in your earnings model that doesn't seem as though you're counting on a huge expansion in margins in 2015 or 16 or 17. So I'm wondering if that's suggesting that you're taking a more conservative approach on this, or maybe that it's not quite as believable as whenever you call something a name like Project K, it seems to me like a marketing gimmick. But yeah. I just wonder what your opinions are.
We're definitely throughout the whole of this valuation and the experience with Kellogg's, it's always been more of a conservative outlook, just because once again they're in a very stable industry, and also we're unsure as a unit of exactly how they're going to do on reducing that margin. Now, obviously, if something great happens and they even achieve 50% of what they're looking to do, they'll do wonderfully. If they do well as far as in getting a little bit of growth from emerging markets, they'll do very well. However, we took a conservative estimate, as in the case with our hold, because if you hold onto the stock, we believe that even with these conservative estimates, you'll be all right. So it's almost one of those things. We're expecting not that much, but we're hoping for greater gains. And by taking a hold, you can exploit that.
As it relates to the joint ventures that they have away from the U.S., are these, and you mentioned about challenges in developing products for the emerging markets, is this designed to have these joint partners assist them with that, or is it distribution, or what is?
I'll take that. In China, they are partnered with a company that has very good distribution network. So they're going to use their products combined with their distribution network to, I guess, get their name known and start actually operating in China. So that's where they're headed in China.
And there's also another joint venture. The name is a little hard to pronounce. Euchre.
I think so.
And it's a cookie, they're merging with companies, they merged with that company to market cookies and other snacks in Turkey, and that's been successful. And that's actually had some decent market penetration as far as that people recognize that brand in Turkey.
As compared to other competitors in the industry, like the investor looking where else to invest, relative to that, is Kellogg at a premium? Is it trading in line with competitors?
I would say it's a premium, but at the same time, I wouldn't necessarily dissuade anybody from purchasing General Mills. And it seems to be when you look at the character of the companies, they're just a little bit different in how they view and how to run their business. Because General Mills, they own some of their own mills and processing plants. They've almost looked at doing more of a vertical integration scheme to generate more revenue and to save money, whereas Kellogg's is all about that relationship with consumers, and that's what they push. Like when we showed up for that meeting, it was all customer relations, brand loyalty, giving something other than the cereal. They were talking about their Olympics commercials and really associating family values with their product. So,
Thank you.
Great job.
thank you.
Thank you.